Welcome to David and David on Real Estate. Join us as we explore the ins and outs of the real estate market.
Good morning and welcome to the David and David on Real Estate podcast. And today we are on episode number 47. Welcome everybody and thank you so much for joining us. Today we have with us Sean Hurley. And Sean is not only a really good friend of mine, but I consider him my go-to insurance advisor. So Sean, thank you so much for joining us. It's a pleasure to finally have you on the podcast.
Well, I'm delighted that you thought of me. I was really glad to be here, so thank you.
Absolutely.
Well, insurance is a topic that we were hoping to get to. We haven't really covered it at all in these podcasts, and we thought you'd be the perfect guy to do it because you're probably the only guy that can make insurance exciting, entertaining, interesting.
Well, I shave, I wear deodorant. I mean, those are the first two good steps, right? So,
Sean, tell us a little bit about yourself.
So, well, first of all, thanks for having me on. And I really, I have an interesting story because my dad, he really suffered a lot from dyslexia way back when they didn't know when it was. He was born in 1922, and he was a paranoid saver because he remembered the Depression. So in 29, the Depression hit, and he lived in a very wealthy family. His father was a doctor, so he saw people in Toronto in 29, 30, 31, 32 regularly going through their garbage for food. You know, people don't realize that in Canada things were like that, and he saw that, and because his father was a very prominent doctor in the Catholic community in Toronto, they would never let my father fail. Failing was, you know, it's your marks, and if you failed, you failed back then, which is what I believe in anyway, but that's another story. And so it turns out that he kept getting pushed on, and he didn't know how to read. They didn't know what dyslexia was. He was good at math and drawing. It's the only thing he really knew how to do. So he got to grade 9 at St. Mike's College School, and he got kicked out of English, and the principal gave him an evaluation. He said, listen, you read at a grade 2 level, you're going to be doing English in my office from now on. He did that from grade 9 to grade 12. And because it was during the Second World War, they had this thing called, there was a special test you could take in April, as long as you had a job lined up at a farm, because it was big about, like, you know, we had to do a war effort of producing. So he had to get these tests passed, and the principal, knowing his challenges with reading and comprehension, because he spoke very well, he's an intelligent person, but just couldn't comprehend quickly when he read. He actually gave him all the exams, and wow. Because he said, you know, you're not dumb, you just can't read well, and you know, you got to get out of high school. So it was a very generous thing, and it allowed him to get into engineering, which is something that he could actually do because he understood numbers. And then he got into construction, and he saved all his money, and for $35,000 on Mississauga Road, 1957, he bought 2.2 acres on the corner of Dalton and Mississauga Road. And that's where I grew up. And there were 6 children, and I was born when he was 52. So I had a very interesting upbringing. He was very frugal, and we lived on a very prominent street. You know, we skied at a very renowned ski club. I hung out with a lot of very wealthy people, but you know, my father was always very frugal, and you know, always bought used cars, and he was petrified of being poor because of how many limitations he had. And so when he bought that house, I did the math once, and when he bought that house, he had saved in today's money $850,000 by the time he was 36. Cash. And wow. He bought the lot and built the house cash. There was no mortgage on that house, and he was very proud of that, and he saw that as the only way he could do it, because he was just like, we should all have that fear, right? Anyway, and so a little bit about myself. So then I was, being the youngest and being into music and stuff, I was always, you know, promoting things. My father always said I was going to be a salesman because I knew how to talk. And so you know, I went to school for music. I was put into French school as a young child, so I learned to speak French when I was 3 and continued till grade 13 or grade 12. And then I went to Ottawa for university, studied music, and I was doing different kinds of jobs. And then I got into a summer job that was, they said I could make $1,000 a week, and it was selling energy door to door. And for those of us who are honest selling it, it was a good product as prices were going up, and people are saving money because of that. But I learned a lot. I learned a lot about, how could you call it? I learned a lot about people. And somebody at my ski club said to me, who's a nationally renowned life insurance agent, he said to me, he said, Sean, you should come to my office and we could chat, because he saw me grow up at the club. And actually, funny enough, I was thinking of writing him a letter, and I like handwritten letters, and I like handwritten envelopes, and like specially chosen stamps. There's something nice about that, anyway. So his name is John Firstbrook, and we're very different people. He got into life insurance when he was 18, and he just, he's a member of all the right clubs and everything. And long story short, it turns out that he suggested to me to go get trained. And then after a couple of years to work for him, which is what I did. I went to Sun Life and got trained, worked with them for a little while, worked with an independent fellow for about 2 years, who I'm working with now, actually. Then I went to work for John Firstbrook. And John Firstbrook's tagline was tax effective savings. And I found it.com. So I bought it. And that was my business model, let's say, of my job is to help my clients tax effectively save using life insurance. But until I went to his office and saw the power of all the different ways that can happen, his secretary was a real blessing to me, and being there. And then I came back to Mississauga on Sherwood Town Boulevard and started working out of the Crossroads Insurance and Investments office on Sherwood Town. And I was working under my own brand, but I was working with that team. And that's I guess the Coles Notes version. I can talk a long time and real long, but that's the Coles Notes version of professionally. I'm married. I've my wife of 20 years this September. People say to me, they go, what's marriage like? I go, it's the best, hardest thing you'll ever do. So yeah, 20 years, we got 4 kids, and I've been selling life insurance now since 2006. So it's going to be 16 years. 16, this past May was 16 years. So it's been a long time. So there you go.
And it's not just life insurance, right? There's different forms of life insurance, but you're also doing disability insurance,
correct,
as well. And and part of the life insurance, I know that you also get into stuff like key man insurance, which is a form of life insurance just used for a different purpose too.
Sure. Yeah, the envelope, just to touch on what you said, David. So given that you're both David, do they ever refer to you guys by your last names on the podcast to not get confused?
The initial, David G, David K.
Oh yeah. Well, Korman and Gorski sounds like a big multinational something. So anyway, no, all jokes aside. So the in the umbrella of the life insurance world, like when you take the test, you have to learn about all the different aspects. So there's life insurance, there's on the term side, which is basically rental. Then you've got permanent insurance, which is insurance that's meant to last your whole life. And it usually has a component in it where there's money that's available inside the policy for you for whatever purpose you choose while you're alive. And then there's disability insurance, which is actually the highest likelihood of any working adult is becoming disabled. It's much higher than premature death, and it's higher than critical illness. Excuse me. And then there's critical illness, which is basically a contract that protects you against the diagnosis of the named illnesses in the policy. And then finally, there's something called annuities. And annuities are basically a product that you give a large amount of money to an insurance company, and that they guarantee you that they're going to pay you monthly for as long as you live a certain amount of money. And in the last number of years, they've actually come out with a contract that if you die prematurely, it guarantees the payout to your heirs up to 20 years. And that's an added feature you can add. That's for people who are worried about the market, worried about ups and downs. Maybe they're not good at managing money. Maybe they have an heir that they'd like to leave a large sum of money to, but they want it stipend on a monthly basis or annual basis. And that's annuities. And with the interest rates that we've had lately, annuities haven't been as popular as they have, let's say, in the past, but they have their place, So hopefully, that talks about the products that are inside the life insurance world. Now, David, the lawyer, who just said about the key man and all that. So the different aspects of where you can aim the purpose of your life insurance is something that we can dig in a little bit after the intro and wherever this organically sort of takes us through our chat today.
And I think insurance is one of the greatest business ever invented, because people pay for something that they hope they never use or never really need the benefit of for years and years and years. And it's different than other types of services, other types of anything. Like people buy a house from me, they pay me for legal services to close that house. They don't pay me beyond the closing. In case a title issue comes up at some point in time in the next 20 years, keep paying me every year the same fee, just in case something goes wrong or something shows up. Like that's the greatest business ever, that you keep getting paid, right? But and that's sort of the way but it's all based on the numbers.
Well, it's you just brought up something that's not even in our outline. Like I'm sure your listeners know that, before these chats, we do like an outline of what we might want to talk about, things like that. But one of the things that wasn't in that outline that you just made me think of is I know a lot of people, like I tell people this, I say, there's two sides to life insurance. There's emotional and then there's logical. And the emotional side of it is something that you really have to take into consideration, because if you don't, then people are uneasy about the selection they make or the choice they end up with. And then on the other side, there's the mathematical side. And then depending on the culture where people come from, typically, not always, but typically, like I'll give an example, Southern Europeans tend to be more superstitious, and they tend to have a bit more of like, the handbrake's always on when they talk about things of this nature. And here's the reason why. It's because they're like, I don't understand it. How can you mathematically guarantee to pay me $1 million if I am, let's say, 40 years old? I'm just picking a number out of my head, and all I'm paying per month is $65 a month. And as long as I'm paying my premiums, if for some reason, God forbid, I don't go home and I'm dead, you're going to give $1 million tax-free to my family. It doesn't make sense. So I have to talk on that now. There's a magical pile of money under the Hudson's Bay. I'm just kidding. That's a bad joke. No, what it is it's actuarial science. And I know it sounds like a fancy word, but it's basically the scientific study of mortality. And they actually know, like I know I look like I'm only 25, but I'm actually 48. So of the 48-year-old non-smoking males in Canada, they know down to the 10th of a person. I know that sounds funny, but to the 10th of a number, how many people my age in my category are going to die this year. Like they really do know it. So that's one thing. And then the other is, because of that, it's a giant pool, right? So I'm only paying $46 basically, or $64 or whatever it is. And then that pool takes care of the 57 people, 48-year-old male non-smokers who die that year, right, and take care of that. And the other thing too is, in the insurance industry, I don't know if people have ever known this or not, but there's two levels of insurance. There's the insurance that the public never talks about or even deals with. And then there's the insurance that people deal with, like Manulife, Equitable Life, Forester's Life, Canada Life, like the list is long. But all of those life insurance companies that have brand names talking to the public, when they sell you a policy, they only sell you a portion of the risk on their own shoulders. The other portion of the risk is actually sold to what's called reinsurance. And reinsurance only deals with insurance companies. So it's like a wholesale insurance conglomerate. There's, I believe, 4 of them in Canada. And they basically buy portions of risk from insurance companies to help keep them liquid. And in the insurance industry is very conservative. They don't shoot for the stars. They're not ambitious. And so the reason I'm saying all this is because, they already know how much money they need to pay out the premiums. And then what happens too is what keeps the premiums low is the fact that a lot of people, only 2% of all the term policies, if everyone who buys a house, they got a mortgage, the cash is tight, but they need life insurance, they buy a term policy. Well, of all the term policies that are ever sold, only 2% of them ever pay out a benefit. So it leaves a lot of cash on the table. And that's how insurance companies make money. That's how they pay the commissions. And that's how they keep the premiums cheap, because, you know, not a lot of people die with term insurance. So those people who think, well, my term insurance is going to serve me, it's only serving the window that we're talking about. It's not going to be a part of your estate when you die. Because
Right.
most people today,
It's protecting you if you happen to be in that 2%, right?
yeah, of course. Yeah. And if you don't have the money to because like a permanent insurance policy is almost like a house, right? Like you're investing in something that has a guaranteed return. It has a guaranteed payout, and it's something that you're just putting into, kind of like your home. And when you need it, it's there. Anyway, so that's.
I wanted to jump in here for a second. I mean, you know, term insurance definitely has its uses, and it really depends on, you know, what stage of your life you're going through, and your particular circumstances, right? And, you know, I'm going to talk about my circumstance really quickly. You know, I made a significant investment, and I bought into the brokerage about 4 or 5 years ago. And at the time I was newly married and was starting a family. And you know, we took on some debt to buy the business. And, you know, one of my goals was to protect my spouse in case anything happened to me. And I knew that I didn't have to protect her for a really long period of time, because every year that passed, the business was generating revenue and the debt was being paid down. And once that got paid down to zero, then, you know, I knew that the amount of protection wasn't as important as it was at the very beginning if something should have happened to me. So in that circumstance, you know, term insurance was the perfect product for me at the time. And I think there's a lot of life circumstances that can happen where term insurance is the right product to start off with, or to supplement coverage, or to have a temporary amount of coverage. You know, as you're building, as you're buying different businesses, as you're taking some risks, you know, you want to protect your estate and you want to protect the people that you leave behind. Sean, you're muted.
Forgive me, I did that to not distract with what you were saying. You're exactly right. And term is like, it's almost like just a Band-Aid. Maybe not a Band-Aid, but it's something that you need for a term. It's like the name is very, very purposely put like that. And so, you know, as we get older, like, you know, I have some clients who buy permanent insurance. I tell people this: if you're going to want money, cash for your heirs when you pass away, it has to be permanent insurance. And if you can only buy something that's going to cost you $300 a month right now, then buy it. It might only be a $75,000 policy, but it's better than nothing, and you're getting it at a price that's super favorable. And so I think that you know, for anyone who's got any kind of debt at all, and it's not debt that's backed by their own assets, but even people who have their own assets to back their debt usually buy life insurance, because who wants to liquidate assets to pay a debt? Like, you know, nobody wants to do it. It's funny how I could just like run down so many different streams of talking about different parts about this, but it's important. And also, you know, being from the background of the arts, right, coming from music, sometimes my head's kind of like a pinball machine, so I have to stay focused.
Well, maybe, you know, while we're talking, maybe just explain the differences between term insurance and permanent insurance, and any of the other term you hear is whole life insurance, I think is the other, or universal insurance.
Correct.
You hear these different terms, so maybe just run through the differences.
Okay. Well, term insurance is rental. The best way for a layperson to think about it is you're renting insurance. It's just like car insurance. Every month you pay for it, it's there. If you miss a payment, they give you a grace of 30 days, and then it's gone. And if your health has changed in that time and you want to sign up for it again, because it's all based on health, that's one thing I mentioned, but some people might not know this, but you have to qualify with your health. They ask you health questions. They oftentimes talk to your doctor, and they oftentimes send a nurse to your to take blood, do your blood pressure, take your height, take your weight, because they're insuring your life, right? Like your ability to remain alive and live to life expectancy. They know the statistics around accidents and stuff. So that's term insurance. It's typically used for short-term debt between people, debt between business owners, debt between a bank and a homeowner. It's also used for income replacement. So let's say a young father has a couple of kids, they're living month to month because they bought a house that they really wanted, but it was a little bit more than they expected to pay. Does this sound familiar? Anyway, and then all they got, like I say to them, hey, well, just cover this. It'll cost you about $50 a month. They're like, where do I sign? Because it's good value and it does the job. So his mortgage is, I don't know, let's say 500 grand. And all he wants to cover is his mortgage. So that if he doesn't come home one night, his lovely wife and kids, they own their home. And here's the thing I should say, because people get life insurance from either the mortgage broker and his contact or the bank. And here's the problem with that is when you buy a policy that is in your name and you're the contracted person between you and the insurance company, my place in that is I represent the policyholder. So I'm representing the person that's buying. Well, the thing is you're the one who's being protected. So when, God forbid, if the husband dies, the wife has a choice. The widow has a choice. Do I want to pay off my mortgage, which is at 2.9% for another 4.5 years? Or do I want to invest my money, just keep paying my mortgage and take a year off work because I just lost the love of my life? You know what I mean? It's so many more options. But when you buy it through the bank, not only are you paying a very expensive cost of insurance because it's a pool of way more people with a lot worse health than just your exact health picture. And also, guess what happens when it pays out? The bank says, oh, we wipe out that debt. We take the money from the insurance and we say, here's the keys to your debt-free home. Now you go find a widow that wants to take a year off work who can go get a line of credit on her house. Not to say it won't happen, but it's not as easy as somebody, or let's say she never worked. It's tough. So I tell everybody that the insurance you get from the bank is a sham. It does pay, but it pays them. It protects them. And when you buy a policy for yourself, all the options are open. And so that's for the debt side. I was talking about income replacement. So I oftentimes
Sean, just sorry to interrupt you, but I think that's a fabulous point because I'm not in the insurance business, but when we, as a routine part of our closings, when we have mortgages, a lot of the financial institutions, they send us their insurance package with them, and they basically try and use us as their insurance agents because they're sending us all part of their closing documents. Oh, do you want mortgage insurance on this? Yes. Okay. Fill out this application. And they're supposed to fill this application with us there. We're not insurance people. Yeah. Or no, you're going to say, oh, so I have this conversation all the time when I'm signing up people, but I say exactly what you just said. Yeah. Okay. I said, I'm not in insurance business. I don't, I'm not an insurance salesman. I'm not acting for the bank. I'm acting for the bank to make sure I get a mortgage registered for them, but I'm not their insurance salesman. But the one thing that I do know, you get all mortgage insurance is life insurance. So upon your death, the mortgage will get paid out regardless of, you got a mortgage at 2% and the rates are way higher right now. You have no choice. The mortgage gets paid out, right? If you go get your own insurance, go talk to Sean Hurley, get your own insurance, life insurance policy. Upon your death, your beneficiaries decide what to do with the money. If it makes sense to them to pay out the mortgage, they'll pay out the mortgage. If they want to do something else with the money, because they can invest it at a higher rate or do something else with it, it's their choice, right? So I have that conversation every single time I convince them not to get the life insurance. At least think about it. Go talk to a Sean Hurley first. You can always go back and get what the bank's offering, right? But and they use us as their salespeople. To me, it doesn't make sense.
There's one point about that too that's technical, but it's also crucial, is when you do the contract with an insurance company like Manulife or Foresters Life or whatever, you end up doing all of the health tests upfront So that's why the company can't back out. But when you get those other types of insurance, what they're actually not contracts between you and an insurance company. What it is it's a pool of insurance, and you get a certificate of a certain amount of money from within that pool of money. And so a lot can happen when you don't have the security of having your name on a contract with a life insurance company, because they can do underwriting at the end. They could say, oh, we didn't know he smoked this or had that or had this health history. And, you know, like just like any business, uh, just like any business, they got they try to be efficient. I got someone ringing the doorbell to my office. Can I jump for 1 second and just tell them I can't? Yeah, they won't stop me. They're just going to keep ringing. I know who it is.
Sure.
Sorry about that.
No problem. No, I think it's an interesting point. And, you know, and like I said, David, like, you know, I cut that conversation off pretty quickly. I don't think I've ever had one when someone says, no, I want to go for the life insurance right now. Let's fill out the application, because I have no patience to fill out an insurance application when I'm doing a sign-up meeting. I say, no, you're better served if you really want insurance. Go talk to an insurance person first. You can always go back to the bank and get it.
Yeah, and I think Sean makes an excellent point. You know, I mean, you know, there's pre-existing conditions. You know, you don't know what your health is like. I mean, if the insurance company finds out that you had cancer or you have diabetes or heart issues, then, you know, you might be in a situation where the family thinks there is coverage. And then God forbid something happens, and, you know, they, like Sean said, they do the underwriting at the very end. They say, well, you know what, you had this pre-existing condition. We didn't know about it. We're going to, you know, refuse to pay. And then, you know,
they give you back your premiums. Isn't that kind, eh?
Yeah.
Anyway, it's just it's a poor product.
Yeah, and it's basically a form of term insurance anyways.
It is.
And if they
It's
actually even talk
term.
to you, you know, you might say, well, yeah, you should definitely have insurance, but instead you could still do term insurance, but here's another option. Here's permanent insurance. And then you explain the difference.
Exactly. Yeah, totally.
And Sean, there's a lot of names for permanent insurance. I mean, I think David used some of them: whole life,
Universal.
There's three. Yeah, there's three. So there's universal life, whole life, and term to 100. And I'll go over them now that it's come up. So you may remember I referred to the fellow John Firstbrook earlier on. He called universal life a train wreck. That was his name for it. And here's why. So this is the story behind it. At a company called MetLife in the States, nothing existed in the world of insurance for permanent insurance other than whole life. And whole life is a very conservative product. It usually is below where the returns are on the market slightly, but you can never lose your money. There's lots of great things. I'll talk about that in a second. But with universal life, there was a young fellow at MetLife who went to his managers and said, why don't we come up with a product that separates the investment from the insurance so that the customer can make their own investment decisions and lose and earn money based on what they choose to put their money in, kind of like your mutual funds portfolio, but inside your life insurance policy. And then what we'll do is we'll sell them the cost of pure insurance, and we'll just have a small management on what the investments they choose. So it's very, very flexible. But one of the problems with that is because it's so flexible, people don't usually treat it the way it needs to be, and it doesn't grow the way it's supposed to. It can lose money. You can end up paying for it the rest of your life. You know, most whole life products can sustain themselves after 20 years. You don't have to put more money into most of them. So that's with universal life. So it's a pure amount of insurance that has one price. You can either do yearly increasing, which is a real sham, or what's called level, which is the one most people get and the one people should get. And so the level one, it gives you, let's say it's $1 million policy. You have a cost of insurance for the $1 million that's guaranteed for life. And then you have an investment portion that you have, because of how much money you're putting in for the $1 million, it gives you a certain amount of money per year that you can put into the policy tax-free. And anything beyond that is taxable. So each year you can do that. And then you're managing where those investments are. So, I mean, it does have its place. people who are really savvy investors, that's fine. Because back in the day when they invented it, people were borrowing against the cash value of their whole life to go into the market, make more than the interest, and then pay it back. That was what it was. But let's go down to whole life. Do you guys have any questions about the universal life?
No, go ahead.
Okay, so
I don't anyways, David.
yeah.
No.
So the whole life is a very interesting concept because you're paying the entire premium, and based on your premium, you're able to participate. That's why it's called participating whole life. Participate in the dividends that their participating fund declare at the end of each year. So your policy earns dividends, and those dividends grow tax-free inside your policy. And this is the one key thing that a lot of people don't know, is that the dividends are vested to you every year that they're given, which means that the company cannot take away any of your money. So if you're in year one, let's say your whole life costs you, for easy math, 10 grand a year. So at the end of your first 20 years, you've spent $200,000 on this policy. Well, your cash value is probably going to be somewhere between 215 and 230,000. It's grown to there, not paid one penny to the government, no money in tax. And the dividends at that point are so big that it can cover the $10,000 annual premium of the policy. So you could take a holiday from paying your premiums, and the policy will continue to compound tax-free in the policy. And so, but every year, like let's say the market takes a real crap, and you're in the 20th year and everyone else's portfolios fall. Well, the cash value in your whole life is guaranteed to never be reduced, because every year they vest it to you and it's basically your money. They can't reduce it. So that's phenomenal. And then also throughout your life, you have access to that money in 3 different ways. You can either borrow it straight from the insurance company. So borrow money against it. So the insurance company knows how much money you have in your policy. You take a loan, they charge you interest. The interest is actually part of the profits that go into the par fund. So it's kind of like borrowing from your own bank, let's just say. The other way is a withdrawal, and a withdrawal does activate taxes because you're taking it out of the tax-free environment of the life insurance policy. But they are favorable because they're dividends and they're not like investment income or salary, let's just say. And then the last way, which is the most common way, is people take their policy to the bank and they say, hey, I got this policy. It's got easy math, I don't know, $300,000 worth of cash in it. And I want to start taking out 15, 20 grand a year in retirement. So they give you a line of credit up to 90% of $300,000, $270,000 line of credit. And all you pay is interest on that. And you never actually touch the policy. So the policy keeps growing the way it should because nothing's been molested, nothing's been disturbed. And then you're just dealing with this line of credit. The bank goes into a legal agreement with the insurance company as first payer for when you pass away. Let's say you used up $200,000 by the time you die. That policy pays out. And then the first part goes to pay off that $200,000. The rest goes to your heirs, 100% tax-free. And it skips probate, and probate is about 1.5% of someone's estate. So, probate can take a long time. So that's a big point as well.
Yeah, well, just touching on the probate issue, one thing that I'm always, talking about when I'm discussing that is, when people do get a life insurance policy, it's really important that regardless of what type of policy it is, it's important for them to name their beneficiaries right in the policy. What, did you just lose Sean?
I think we just lost connection with him, but he should
Let's get him back.
Maybe. Yeah, we'll get him back.
Okay. So the people, it's important to name your beneficiaries right in the policy so that upon death, the life insurance company pays the beneficiary. If you don't name somebody, then the life insurance policy pays the estate. And that becomes part of the probate process, and you have to pay the government that tax that Sean was referring based on the value of the insurance policy. So if it's $1 million insurance policy, you're paying, $15 for every $1,000 worth of value to the government just to get that to your beneficiary. If you named that beneficiary in the policy, it's not part of the probate thing. Can we get him back?
So not yet. So probate is approximately 1.5% of the value of the estate.
Right.
Gotcha.
Right.
There he is.
So anyways, it's, that's a big point, and I'm sure most, agents should be telling them that when they're signing up for policies. It's an important point, but we see it all the time that people have insurance policies where, welcome back, Sean. Just mentioning the fact, how important it is to name a beneficiary, regardless of the type of insurance policy. It's important to name the beneficiaries right in the policy, because otherwise the insurance company upon death pays the estate, and that becomes part of the probate fee, has to be paid on the value of that insurance policy.
I know.
Right. But if they name a beneficiary, the insurance company pays directly to the beneficiary. It's not part of the probate process.
It's also private, because it doesn't show up when people search the will that is submitted is public record, right?
Yes.
Yes. And then you, Mr. Korman, you could talk to this point. Is it still common today for successful Canadians to have two wills?
Yes.
Yes.
Yeah. Well, yeah, we do two wills for anybody that owns private shares, like a holding company.
Yeah.
It's not for if you have shares in a publicly traded company, but if you own shares in a private company, most of the time it makes sense for you to have what we call a dual will or a secondary will. One will that deals with all of your everything else, all your other assets, and one that just deals with the shares that you own in your private corporation, because you can deal with that without doing it as part of the probate process.
Right, because they're only going to probate one will, right?
Right.
Correct. And yeah, I was told once, correct me if I'm wrong, but you put the things that don't trigger tax in the public will, and anything that triggers tax in the private will. Yeah.
Yeah.
Interesting. Okay, so I went over whole life. I went over universal life. The last one is term to 100, which is just like the universal life, where I said it was a fixed cost of the pure insurance. Well, it's basically just that. You can't put money in it. You have to pay till the very end. And if you miss one payment, you got a 30-day window of grace, and then you're gone. So there aren't a whole, people who are on a really tight budget usually go with something like that. And so, that's those are the three areas of permanent insurance.
So Sean, maybe just touch on, regardless of the type of insurance that you end up selecting, you go through a process to apply.
Yep.
And some people are petrified of the application process. They got to answer a bunch of questions. They got to have a medical. They got to, they know, everybody knows there's a difference in what you're going to pay if you're a smoker or non-smoker. And I assume people are lying all the time saying, I've never smoked in my life.
Wow.
Right.
Yeah.
But you got to really be careful with that.
Well, that's a very good point. And I'll tell you, so the process is, it's not an actual medical like your doctor would give, but it's a paramedical exam. So they take blood, they take urine, they do height, weight, blood pressure. Sometimes they'll do a resting electrocardiogram. And if you've answered certain things in your application, they will actually send a questionnaire to your doctor. So here's one thing I say to people before they apply. I say, whatever you're going to do, don't go, unless you have any outstanding medical tests, don't go to your doctor unless it's an emergency until we finish this process. Because there are questions that are based on your best knowledge. And if you find out something that's your best knowledge that you could have waited a year to find out and it wouldn't have made a difference, it's just screwing up your life insurance health rating. So, we talked about term insurance. Term insurance is the only insurance that can give you preferential health rating. So it's the cheapest one. It's the one that when you've got a big thing to cover, it's good to have. It's a big, huge umbrella. But permanent insurance, they don't give you preferential health, but they do give you ratings for when your health is substandard. And so I tell people this, I say, listen, don't stress about it. Just, avoid rich foods, avoid alcohol, avoid caffeine a couple days before, book your appointment in the morning, fast before you take your appointment, and you'll get the best, because it's a snapshot. It's like a photo of that moment of your health. So if you can, it's like, when you're going to visit grandma, you put on the nice shirt, you just do your best, right? You want your health to look the best. And then once that's done, it doesn't really matter what happens to your health after that. That's one of the other beauties too. Like, so coming back to the term, the relationship between term and permanent. Term is rental, permanent is ownership. Term is cheap now, very, 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 very expensive, and expires. Permanent is expensive now. It has a big price tag, but the long-term cost is very low because it starts to pay for itself after 20 years, except there's lots of advantages. But the nice part is this, is if you get in the door with term, like I'll give just a quick example. A guy's starting out, he's a lawyer, he's at a firm downtown, makes a good income for his age, but he's expecting to make a lot more money, but he's also burning through cash like crazy. I tell him, I say, listen, just get all term, get a $2 million policy. And the great part is that as long as you keep that policy with a good company that has a good whole life, you're guaranteed, even if you're like uninsurable after a year from now, you're guaranteed that they're going to give you a guaranteed conversion from term to whole life, no questions asked. They can't ask your doctor. They can't do a blood test. They basically cannot say no. So that's amazing, right? So people who think, oh, I'll get life insurance later, it's foolish. I've had a number of people, and I was upset because they were ready to spend a lot of money, right? And I make money on commissions. It's common knowledge. They wanted to spend a lot of money, and their health was foobarred. I was like, dude, there's nothing I can do for you. I've been talking to you about this for what, 5 years, and now, and only 3 months ago, you went to the doctor and he said that you've got this hole in your heart that we didn't know about or something. A 38-year-old guy making $500,000 a year needs insurance for taxes, for family, for everything. And, he's off the boat. He'll never get insurance ever again. If you have a heart incident under a certain age, you're basically off the boat. They'll never give you life insurance. So it's good to get it when you're young.
Yeah, and I know just part of the questions that you're asked, deal with family history too. So you could be healthy yourself or not know of any issues, but if there's a history in your family of certain things, that triggers other questions. And
true,
right?
It actually only affects more critical illness. So when you're applying for critical illness, that has a much bigger impact on that than it does life insurance. So I just looked at the time. There were certain things I actually really wanted to touch on, because I think that for people to get an idea of why the successful families in Canada use life insurance more than anything else, I'm gonna explain it in a nutshell. In Canada, we all know what an RSP is. Well, corporations don't have RSPs, but wait, I'm trying to be funny, but wait, there's something that works just like an RSP in a slightly different way in a corporation, and it's corporately owned life insurance. Because life insurance grows tax-free, it's the only vehicle that a company could use that has an early premature death safety valve, which is the death benefit. It grows the money tax-free, so it's growing within the corporation, within the policy, tax-free. And this is the beauty, and this is the squeeze out that the wealthiest families in Canada are able to maintain their multi-generational wealth on, and this is what they do. When the patriarch of the family passes away with $10 million of life insurance, that life insurance owned by a corporation pays into the corporation. And everyone's like, okay, what's great about that? Well, because it's life insurance, 100% of those proceeds, as long as they live beyond the age of like 84, 85, if not, there's an adjusted cost base, and some of it could be cut back, but no more than 15%. So in that $10 million example, if a patriarch of a family was to die prematurely at like 55, then that $10 million payout, 8.5 would go out tax-free through the capital dividends account. And then the 1.5 that was held back because of the adjusted cost base, it would have to go through the taxable means. But that's uncommon because not a lot of people die before life expectancy. So basically, we'll take it like the 90-year-old patriarch. He's done great things, made a lot of money, $10 million policy, pays out, goes to the corporation. In the will, that corporation's shares go from the patriarch to his 2 children. Those 2 children are now the shareholders. And the corporation can now declare a tax-free dividend for the total of that policy, which is $10 million. So think of it. He made the money, he paid corporate tax, and he didn't pay personal tax. He started saving it then. So in that business, let's say he was paying 15% instead of 50%, because he's a successful guy. So he's making that spread of 35% that he didn't pay to the government. He's able to put that into a savings vehicle. The savings vehicle protects him while he's young, because if he dies prematurely, even after the first year, it pays out. It grows money in the policy tax-free. It pays out to the corporation tax-free. And then there's a tax-free dividend of all that money to the next generation. It's like, it's fun. It's good. That's the way it works. So I think that, on the business side, that's very important. It works with professional corporations. I have a lot of lawyers. I started promoting to all the big firms downtown many years ago, and a lot of the lawyers there are doing very well. They're my clients, and they're now getting professional corporations. And I'm telling them that the best place to hold this stuff is in a holding company, because the professional corporations, well, why don't you talk a little bit about that, Dave? Like Mr. Korman, to be specific, about the difference between the professional corporation and the holding company. Would you agree that it's probably best to hold in a holding company as opposed to a professional corporation?
Well, I defer to your expertise on that, because there's advantages to it. But I know from what I've been told that it's certainly better to have it in the professional corporation than have it personally.
Yes.
But I think you're saying it's even better to have, if you have a holding company, better to have it in the holding company than in the professional corporation.
Because of some of the stipulations on who can own the professional corporation. If your children aren't lawyers, you can't,
right.
You can't do that stuff. But
right.
Here's the neat part, is between your professional corporation and your holding company, corporate to corporate cash transfers are tax-free, because the government knows they're going to get it eventually, right? So what you can do is you can earn in the professional corporation, do a tax-free transfer to the holding company, own the policy there, have it there. The children become the shareholders of the holding company, and then it's simple. It's simple to deal with, and it literally magnifies wealth. So that's on the corporate side. Now I'm just going to talk a little bit about critical illness. So I have a family member who had a stroke when she was 46, and it was because of soft ice on a skating rink, if you can believe it. She broke her ankle. She went in, it was a compound break. She went in for an operation. Everything was fine. She woke up in the morning and the left side of her body was paralyzed. Luckily, she's recovered significantly, but she still has a lot of trouble. And they didn't have critical illness insurance, and they were and she's from a very financially stable family. They were running around to get lines of credit, because the first 90 days of a stroke is essential for all of the therapies that you can do. But we're talking about what, $4,000 to $10,000 a month for 2 or 3 months, just to try and get your brain making the new connections it needs to recover. So I tell everyone, before that happened to my sibling, I would say, oh, and I sell critical illness insurance. Let me know if you want to talk about it. Now it's everyone needs at least $25,000, because $25,000 worth of critical illness insurance is $22 a month. And if you get that bad news from the doctor, $25,000 is a lot better than a kick in the ass, So that's good. Disability, it's the hardest one to get. It takes the longest. You have to prove your income. It can't be on declared income. And business owners should have it, because unlike critical illness, which is a lump sum, you get diagnosed 30 days later, you make your claim, and they give you a lump sum. Disability is an ongoing payment at a portion of your actual declared income that the government recognizes, a portion of that you've chosen and that you are paying this protection for. And if you become permanently disabled, it will protect that. And then I guess what I could say to people is that they should be getting policies with companies that have a whole life to convert to. A lot of companies don't have them. Whole lives are not easy to manage. There's only 3 real whole lives that have never disappeared. A lot of companies have taken them off the shelf and then years later reintroduced them, and they reintroduced them with numbers from their old product, which in my opinion is not honest. But basically, Canada Life, which is Canada Life, London Life, and Great West Life, they're all the same company now. So Canada Life, Equitable Life, and Foresters Life are the ones that have had a whole life, like a seamless line, right? They've always had it. And people are buying other whole lives from Sun Life, RBC, Manulife, all the companies, and they're big, solid companies, but they don't have the track record. And like right now, I think Canada Life's par fund is like at $36 billion. Like, it's gigantic. So that's, I don't know if, I mean, like, we had a whole bunch of things that we had thought of talking about. I should actually look at the list, because there was one thing.
One of the things that I thought we should spend a couple minutes on, I know David wanted you to talk on this, is people dealing with cottages. Like, we're now at the beginning of cottage season, people going to cottages. Cottages are used by families.
Good point.
It works for the first generation. How do we help out the second or third
generation? Well, we're going to do two things. We'll do two things: equalization and also taxes. So I want everyone to understand this one thing: when you die, it's like you've sold everything. So whatever you would owe tax on, you as if you had sold it, you owe it when you die. You have 1 year to deal with it. So I tell people, I say, hey, would you rather pay a future tax bill with your hard-earned, everything you did during your life? You're dead, right? But everything you've done with your life, do you want it to be dealt with efficiently or inefficiently? Everyone says efficiently. Great. Now, next question. Would you like to pay that tax bill at like 37 cents on the dollar, or would you like to pay it $1 is $1? Everyone's like, I want the discount. Great. Then you need life insurance, because life insurance is future money at a discount. That's what it is. Because of the tax-free nature of the way it grows, it can really, like, I'll give you an example. For a GIC to keep up with a cash value whole life policy throughout a lifetime of a person, it has to earn an average of 11.5% because of taxation, right? And the policy over there might only be paying 6, 7, 5, whatever, 4, whatever it is. But because there's no tax, it's just, the momentum is unbelievable. Okay, so the cottage, so it's anything that's not your principal residence is open for tax. So it's what you paid for it. It's the spread between what you paid for it and what it's worth. If it's a capital gain, then it's 50% of that. So let's say someone said, oh, I got a couple of rentals, got a couple of this, got a couple of that. Don't want my wife to sell them. Don't want my kids to sell them. Great. How much has it grown from when you bought it till today? Oh, $2 million. Well, if you were to die today, you would owe 25% of that in tax, because it's a capital gain, right? So you owed 500,000 in tax, but you're only 47. Let's take it out to 89, which is your life expectancy. Do it at 3%, do the thing. So I tell people, buy that now. They're like, I can't afford all the whole life. Well, get most of it in term. And as you become more successful and have fewer debts to pay, start paying into this, and you'll have enough to pay all those things. And then your heirs will have those good decisions. Now, equalization, when you're talking about cottages, here's something that often comes up. They got 3 or 4 kids. One of them is running the business. He's the one that's going to get the business. But how are you going to make like the 75% of the ownership of that company? How are you going to get those 3 other siblings to not be fighting about values and how are you going to pay me and this and that? The patriarch buys a life insurance policy the size of the 75% value of that business, so that the life insurance pays to the corporation. The corporation has the funds to buy the shares from sibling 2, heir 2, 3, and 4. They're happy because they've got the cash, and the family is happy because it's all good. Because here's the other thing too, is because it's a tax-free dividend. Listen to this. If the company was to buy shares, the person receiving it is selling them. So that's profit, right? Oh, you don't want to do profit. So what you do is you keep the shares. So sibling 2, 3, and 4, they keep their shares for a determined amount of time, let's say a couple months. They get the paperwork together. They declare the tax-free dividend of only 75% of that payout, or 100%, because the fellow who's going to keep the company is still there, right? He's still running the company. He's going to be the main owner and everything. So here's what happens: is all of that money gets given as a tax-free capital dividend to heir 2, 3, and 4. They don't pay any tax on it because it came from life insurance proceeds, because it's the tax-free route, right? So now it's in their pockets. They've paid no tax on it. They've essentially sold the shares of that company back to the eldest brother who's running the company. But what they would probably do is just like destroy them. Like, I don't know what the technical word is, but they basically make them null and void. They sign a document that my shares will be nullified. Buddy, who's, let's say, keep it like, let's say there was 100 shares, he's got 25 shares. They become the only 25 shares that are left. And he's now 100% owner of the company. His siblings are still going to come for Christmas because they don't think he's an a-hole, right? And they got their money and everyone's happy. And how much did the patriarch pay for that whole plan? He probably paid between 30 and 50 cents on the dollar of what that plan was. And not one penny went to the government. You know how many people like saying, I don't want to give money to the government. I'm like, okay. So I tried to be concise.
Yeah. Sean, when it comes to realtors,
Yes.
I think, disability, critical illness are really important policies to consider. Term insurance, they should consider based on their individual circumstances if they want to cover debt and leave family in a better position as the debt is being repaid. Whole
Yes.
life is always a great investment, great estate planning, great tax planning for, for future years. But, let's talk a little bit about teams and the relation of teams with a key man policy, right? Because I think that's important. Like, let's say two really big agents decide to work together and they build this great, amazing team, and they're out there, they're serving customers, and the team relies on the success of two really big names. What that team could do is buy cross life insurance policies on both team members.
Yes.
And if something happens to one of those agents, then the other person has some continuity and funds to be able to, explore other partnerships, other relationships, advertise, or even a little bit of a cash cushion to supplement some of that lost income from that other team member that's no longer, earning and sharing income.
There's a lot in what you said, and it's all, you're 100% right on the nail. Just to start this off is so that people understand the overlying philosophy of key man insurance. If somebody would suffer a financial loss, or a company or a team would suffer a financial loss by the death of a particular person, that person has an insurable interest. The phrase insurable interest refers to who's being insured and why is the interested party wanting insurance. Because they always ask you in all the applications, what's the purpose of this insurance? What's the relationship between the policy owner and the beneficiaries, right? Because you can't just go buy a random policy off of some dude, right? And then when he dies, you just make money, right? It's not like that. So in the team thing, those two team members, the two like real hot shots on the team could say, what's it going to cost me to replace you or headhunt for someone like you, or at least have what you're financially giving to our team's expenses during your year or two it takes me to find someone, or not, or whatever. But it gives you options, right? You would use term insurance for that. It's quite inexpensive, based on what it's providing you. And then what you would do is, depending on whether they're working out of you can have real estate corporations now, right?
Yes.
Right. So you could either have it as a real estate corporation, excuse me, or you could have it just like a sort of a crisscross by a partnership, like sole proprietor type partnership. But choosing where it pays out is important, and the purpose for it. Also, for people that put investments into companies, right? Like you've invested a lot of money, or if let's say you own a company, not real estate, but your number one sales guy accounts for like 60% of your annual volume. Like there's a guy you need key man insurance on like yesterday, because if let's say the company's earnings are, I don't know, $1 million, right? So he's responsible for 600,000 of that $1 million of profit that the owner of the company is benefiting from. And he says to himself, what would it take me to replace him? How long would it take me to replace him? And what would I have to pay as a carrot to get that person to leave what they're doing and come and work for me? and how long would it take to get them up to his point. So you do some general calculations, add a 10 or 15% buffer just in case you've underestimated. And you say, I need a $1.8 million life insurance policy on my key guy. And so you get it and you pay it. And then what a lot of owners do is if Buddy retires or if Buddy's moving on, you know, it's a kind thing for the owner of the company to do is to say, hey, you know, there's a life insurance on your life. You've already qualified for it. These are the premiums. I mean, I can transfer the ownership to you because it's term, right? There's no cash, there's no taxes, no nothing. You can take it over and bring it with you. You know, it'll be yours. Or you could just like that. The month that he leaves, that's the nice part about life insurance. You're just covering each month, you know. So when it comes to a real estate team, I think it is important, but it's all based on what is someone bringing to the table in terms of value and what would happen. How would I suffer financially if they were no longer here?
And Sean, I think it's important to also note that the source of funds for the paying the premium is also very important, right? Like it has to come from in a corporation, you can't deduct it from income taxes, right? Because if you expense the premiums, then the policy becomes is taxable.
The benefit is taxable, which is terrible,
right?
Because it's so much more magnified.
Right. You don't want to do that. So what you want to do is you want to make sure that you know, you don't expense the policy premium, that you don't deduct it from your income taxes, and then that makes the benefit not tax deductible. So
correct. It's a non-deductible expense.
Right. So the people who are considering buying insurance in a corporation or in a business or part of a team environment, and I mean, I'm sure this is something that their accountant is definitely going to advise them as well, but just make sure that you don't deduct that premium from your income taxes. Otherwise, you're creating a taxable benefit at the end of the day. And you're not going to take advantage of all these wonderful benefits that Sean shared with us.
I'll tell you, accountants do a great job. I mean, they provide a great, they provide a great software. They don't all do a great job. I won't say that. It's just like any profession, right? But a lot of accountants a lot of the ones that I've met, my accountant's a great guy. Anyway, a lot of the accountants that I've met don't know their head for their tail when it comes to life insurance. But unfortunately, they oftentimes answer the questions beyond where they should. And so if they don't understand it, if they don't understand the tax consequences or the tax benefits of how to hold these things, they could really be doing their client a disservice. Personally, I would not ask any financial information from an accountant. And because
when it comes to life insurance, let's clarify that.
What's that?
When it comes to life insurance, I think.
Yeah. Oh, of course. Yeah. Like, you know. Yeah. No, you're totally right.
We talk about this all the time on here, how important it is to have the right team in place, because it's got to be coordinated. You know, your accountant has to be talking to your life insurance guy, and they've got to be on the same page and understand what the intent is and how it should be structured and set up. Right. So you've got to have good team members that way, and they've got to be able to communicate with each other to make sure that things, you know, it's one thing to have a plan. It's the other thing is to make sure it gets implemented properly.
Jeez.
Right. So the right party's paying the premiums, like David said, and you've made sure you've designated beneficiaries in the policy, and you've completed it properly. And
correct.
So you got to make sure you got someone like Sean that's guiding you through, you know, the application process and making sure that that's done. Because I always get surprised how when people die and they have insurance policies that didn't name the beneficiary, they intended to. They didn't. Like they administratively didn't check that box and put the name down, right?
Wow, that's shocking. Shocking. Sean, I have a question. I know we're running short on time, but I want to get into this really quickly. When you're doing estate planning and writing your will, would you suggest doing your estate planning around the insurance you have in place, or would you suggest like at what point does the insurance component come into the question?
Well, I mean, it's oftentimes mentioned in wills. Depending on the date of the insurance policy or the will, the beneficiary designation will go with the most recent date. So if you've written your will 5 years ago, you just bought a life insurance policy, you named beneficiaries, those named beneficiaries will trump the ones that are in your will. It's not really one's right and one's wrong. I mean, anyone who needs insurance should get it. Anyone who doesn't have a will needs to get it. And they need to be aware of each other, but they don't need to be necessarily married, right? Like, I mean, because the will is to make sure that what you own goes the way you want it to go and to who you want it to go after you die. And insurance is basically the grease and the gears, what helps those things happen, right? Because this is one thing I tell everybody, the tax man will always get his tax. He's always going to get it. So unless you set it up in the way that you choose the way the money's going to go so that it is going to pay tax, but only to a certain amount, well, then that's somebody who is thoughtful. You can't really save the wrong kind of insurance by having a better will, but I mean, I guess you could save a pretty, a will that, let's say, you've never gotten around to changing by getting another policy. If you wanted a particular beneficiary to receive money, a niece or a nephew, or someone who's done really nicely to you or whatever, it's a very clean. The nice part about life insurance is very clean, right? It's all cash. People don't have emotions around cash. They have emotions around cars and teddy bears and cottages and, oh, I remember all my Christmases there, blah, blah, blah. Cash is not emotional. It's easily dividable. Deal with cash, and that's the nice part. Cash isn't evil. Like, I got to tell you this anecdote. I got a friend of mine, well, a client of mine, who said to me, I don't want to make my kids unnecessarily more rich than they need to be. I don't care how much money they're going to get. They're going to get a lot of money. And so my answer to that was, do you want your hard-earned money to go more or less to the government? They say less. I'm like, well, then we're going to do what I say. They're like, okay. I got another doorbell. Let me just shoo them away. Give me one second.
I think we're out of time here anyways.
We are, yeah.
So.
It's amazing how quickly an hour goes, and how I feel like there's so many more levels we could have dove into, but I think we scratched the surface on a lot of important topics and a lot of important discussions surrounding insurance. And the moral of the story is that it's important, and we need to pay more attention. And, we really need to have more conversations surrounding this topic.
And if I could just say this one thing, with the China virus and all that it entailed and still is kind of, the insurance companies have made concessions to do everything remote. So all of my meetings are remote. They're more efficient for time, more efficient for traffic, for fuel, for expense, just everything. It's less cumbersome. It's very private. Everything happens over scanned documents and DocuSign and that kind of stuff. So we're in the 21st century, and anybody who has people who count on them financially, who doesn't have life insurance, you might not like what I'm about to say, but that's not responsible. And if you have car insurance and if you have home insurance, you should have some life insurance, at least to cover your debts, at least to cover a couple of years of your income. It's so cheap. Term insurance is so cheap. So please, anyone who wants to reach out to me, can go through the Dave and Dave to get my email. It's Sean@taxeffectivesaving.com. My website is taxeffectivesaving.com. And I'm here to serve. I love what I do. I'm passionate about it. And, I got lots of hugs and lots of kicks, so I'll give you a hug when you deserve it, and I'll give you a kick when you need it. So.
Well, that's great advice, Sean. Thanks so much for being on the podcast today. It was great information. And like David said, I think we just, in an hour, we can only scratch the surface. There's just so many issues. Yeah. And anybody would be well served to get in touch with you and spend some real time and dig down deeper. And I'm sure you'll be able to help anybody.
Thanks for saying that. And I'll tell you, nobody wakes up in the morning saying, today's the day I'm going to buy life insurance. So if it ever comes into your mind that you need a review, don't delay. It's like teeth, you don't want to delay with that stuff.
Yeah.
So, okay.
Okay. Thanks, Sean.
Thanks, Sean. Thanks for being on.
Talk to you all soon. Take care.
All right. Bye-bye.
Bye.